Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about KNIFE River CORP quarterly report. KNIFE River Corporation offers a diverse range of businesses and services, including mining and selling construction aggregates such as crushed stone, sand, and gravel, producing and selling asphalt and ready-mix concrete, providing contracting services like heavy civil construction, asphalt and concrete paving, and site development and grading, selling cement, merchandise, and other building materials and related services, producing and supplying liquid asphalt for use in asphalt road construction. These businesses and services cater to various customers, including federal, state, and municipal governments, industrial, commercial, and residential developers, and private parties. KNIFE River Corp's stock price has dropped significantly in the past year due to several factors. The main contributors to this decline include reduced guidance and profitability concerns, declining volumes, adverse weather conditions, and underperformance compared to the market. The company's lowered revenue and profit guidance for the year, as well as its increased debt and higher costs, have led to a decrease in net income. Additionally, KNIFE River Corp has faced near-term weakness due to declining volumes and regional funding issues in Oregon. Adverse weather conditions in the Midwest and Northwest have also negatively impacted the company's performance. Furthermore, the company underperformed the broader market, with a price return of minus 37.9% in the last year compared to the SPY ETF's gain of plus 21.2%. The missed earnings estimates in the last quarter, where revenue fell short by minus $44 million and earnings per share missed expectations by minus $1.49, also contributed to the decline. Despite these downturns, some analysts remain optimistic about KNIFE River Corp's potential upside, citing its strong liquidity and overall financial health score as positives. The primary drivers of revenue growth or decline can be summarized into several key factors. On the growth side, new customer acquisitions and increased sales volume from existing customers have contributed significantly. The expansion of product offerings, acquisition of Strata Corporation, and favorable tax policies such as the One Big Beautiful Bill Act, OBBBA, have also boosted revenue. Additionally, strategic reorganization of business segments and strong performance in specific regions like the West segment have driven growth. On the decline side, total revenue decreased by 7.5% due to a combination of factors including internal sales decline, liquid asphalt revenue decline, and reduced contracting services work. Unfavorable weather conditions affecting market pricing and reduced volumes from certain quarries have also contributed to the decline. Net income and profit margins decline due to project delays and increased working capital needs. The company's financial performance has taken a hit, with significant declines in net income and profit margins. For the year-to-date period, net income decreased by $5,953 million, 22.1%, while for the 3 months ended September 30, 2025, it dropped by $5,053 million, 3.4%. Gross profit margin also declined, falling by 2.2% and 0.9% respectively for the 9 and 3-month periods. The main reasons behind these declines are project delays and increased working capital needs. Delays with the Oregon DOT budget and challenges with public and private projects in the West segment have hindered progress and reduced profitability. Additionally, higher working capital needs have further impacted net income. These factors have collectively contributed to a decrease in operating income margin by 3% and 0.9% for the 9 and 3-month periods respectively. The company's financial performance indicates a positive trend in operating cash flow. The net cash provided by operating activities increased from $149.9 million in 2024 to $82.6 million in 2025, despite a slight decrease in working capital components. This suggests that the company is generating sufficient cash from its core operations to support its growth and financial stability. The company's debt level and interest expenses have undergone significant changes over the past year. Long-term debt has increased substantially, rising from $669,672 in 2024 to $1,175,968 in 2025. This increase is reflected in various financial summaries, including a carrying amount of long-term debt that rose from $691,717 to $1,204,073. Interest expenses have also seen a notable surge, with a 65% increase in Q3 2025 and a 45% rise in $9 million 2025 compared to the same periods in 2024. The net interest expense has followed suit, increasing from $12.1 million in 2024 to $22.4 million in 9 months of 2025. These changes indicate that the company's financial obligations have become more burdensome, with a greater proportion of its income being allocated towards servicing debt. The company's financial performance varied across different segments and regions. The mountain segment saw a significant increase in backlog, from $279.9 million to $386 million. In contrast, the central segment experienced a decline in backlog, dropping from $192.3 million to $175.5 million. Within the west segment, which overall showed revenue growth of 3% and EBITDA growth of 8%, Oregon performed poorly due to delays with the Oregon DOT budget and challenges with public and private projects. This poor performance was also reflected in the West segment's backlog, driven by lower numbers in Oregon. Management is optimistic about the company's future, citing a strong backlog of contracts with $994.6 million in remaining performance obligations. They expect revenue growth across all segments, driven by favorable bidding opportunities due to strong DOT budgets in most states. The company plans to expand through acquisitions and capital expenditures, while also generating offsetting proceeds from asset sales. With sufficient liquidity and borrowing capacity, management is confident that the company can meet its financial commitments and achieve long-term profitability objectives. The company has made significant acquisitions and divestitures over the past 2 years. In terms of acquisitions, notable deals include High Desert Aggregate and Paving in Central Oregon Aggregates, and Contracting Services Business in Central Minnesota Strata Corporation, Albina Asphalt in 2024. These acquisitions total $357.7 million in 2025 and $114.1 million in 2024. On the other hand, the company has also made divestitures worth $10,486,000 in 2025, $3,132,000 in 2024. Concerns about inventory buildup and supply chain disruption are evident in the company's financial summary. Inventory levels have increased significantly, with finished products up by 73%, raw materials by 22%, and supplies and parts by 4%. This buildup is attributed to various factors, including reduced work activity in certain segments, lower asphalt volumes, and selling acquired inventory at a markup. Supply chain disruptions are also anticipated due to delays in the Oregon DOT budget, which may impact future operations. Additionally, an increase in cash usage for higher working capital needs and decreased net income suggests potential supply chain issues. These concerns highlight the need for the company to reassess its inventory management and supply chain strategies to mitigate these risks. That concludes the financial summary for KNIFE River CORP. Feel free to comment below, and I will be happy to answer them when possible.